All right, let's dive right into this explainer. Today, we're doing a complete masterclass on leveraging basic financial mechanics to scale your small business, and we're going to do it without any upfront cash. Look, if you've got a passion project or a hobby you are just dying to turn into a real business, but you feel totally blocked because you don't have this giant pile of startup capital sitting around, well, you are in exactly the right place. We are going to completely dismantle that traditional advice. You know the stuff I'm talking about? That old save every penny in a piggy bank for 40 years mentality? Yeah, that doesn't actually build businesses. Instead, we're going to look at how to treat debt like a mechanical tool to build real wealth. So here is our exact roadmap for today. We'll start with renting money and the spread, then we'll get into scaling with trade credit, look at the very real danger of over-leveraging, talk about maintaining positive cash flow, and finally, we'll cover auditing your credit score. Okay, part 1, renting money and the spread. Let's completely change your paradigm about what a loan actually is. I want you to forget everything you've ever been taught about debt being this inherently evil thing or something you should be terrified of, because at its core, a loan is simply renting money. Think about it. You borrow a sum, you pay a fee for the time you hold on to it, and then you give it back. That fee, that's the interest rate. It's literally just the rent. So the only question that actually matters is this: when you put that rented money to work, does it earn more than the rent costs? Let's just run the math real quick. If the money you borrowed earns, say, 7% when you invested in your business, and the rent on it is 4%, you just kept that 3% difference on money that was never even yours to begin with. You are profiting off of someone else's money. That gap, that beautiful little gap, is called the spread. And let me tell you, the spread is the entire game. This concept brilliantly illustrates the difference between people who drown in debt and the people who use it to build wealth. I mean, two people can literally take out the exact same loan at the exact same interest rate on the exact same day. One ends up totally buried, the other ends up richer. Why? Because the average person looks at a loan, panics, and immediately asks, oh man, how do I pay this off instantly? But the entrepreneur, they look at that same loan and ask, all right, what's the spread here and how many dollars can I control with it? Moving right along to section 2, scaling with trade credit. So how do we actually apply this concept of the spread to a solopreneur who is starting out with basically nothing? How do you get inventory without cash? Well, you use trade credit. Let's visualize how this works for your passion project. Say you want to sell a simple physical product, like custom pens. The poor way to do this is to take your own hard-earned savings, buy a giant box of pens, and just pray they sell. Your cash is completely trapped. The wealthy way? You get the manufacturer to hand you those pens on terms, say net 30. They are effectively lending you the product. So you take those pens, you sell them to your customers in week 1, you pay the factory back on day 30, and you pocket the markup. Now, here is the absolute kicker. How much of your own cash was actually tied up in this entire process? Absolutely zero. You just controlled an entire container of inventory with literally none of your own money. And when you run the math on your return, you aren't dividing your profit by your initial investment because you divided by 0. When your initial cash investment is 0, any profit you make means your return on investment is, technically speaking, infinite. Because you divided by 0 of your own dollars, your leverage becomes infinite. And the best part is, you can pull this off today through some really simple mechanisms. If you're a student or a hobbyist looking to scale, you don't need some hotshot Wall Street banker. You just need to negotiate a 30-day supplier term. Or ask for a 50% upfront customer deposit that funds your materials before you even do the work. Or you could just float your initial inventory on a 0% introductory credit card. You absolutely do not need millions to use this strategy. You just need to understand the mechanics. All right, let's get into section 3, the danger of over-leveraging. Look, a good mentor doesn't just teach you how to make money, they teach you how to survive. So we absolutely have to look at the dark side of leverage. Leverage multiplies your spread in both directions. A positive spread builds a business, sure, but a negative spread, that multiplies into an absolute disaster. Sometimes aspiring entrepreneurs get tempted to fund their new business by borrowing heavily against their stock portfolios or other assets that fluctuate in price. But here is the massive, massive risk. Lenders keep a very close eye on your collateral. If the market suddenly drops and your collateral loses value, you're going to face what's called a margin call. The lender will demand you put up more cash immediately, or they will literally force sell your assets right out from under you. It turns leverage from this powerful tool into a deadly trap. I'm showing you this to establish some really clear guardrails and to protect you. Safe, cash flow positive business debt has a predictable rent. It has a floor. The absolute worst thing that happens with regular inventory is it just goes to 0. But risky leverage, like short selling stocks to raise capital, That is borrowing in reverse. If the price climbs against you, your losses climb with literally no limit. Safe debt has a floor. Reverse borrowing has no ceiling. Please never fund your startup using strategies where your losses can go to infinity. Okay, on to section 4, maintaining positive cash flow. Now that we've got our guardrails set, let's see how you can safely maintain your cash flow while you're scaling up this new venture. This is a purely defensive move for anyone managing really tight startup funds. The most accessible, run-it-today trick in the whole financial playbook is floating your business expenses by moving high-interest debt over to a 0% balance transfer card. Let's say you had to put some initial marketing costs on a credit card that's charging you like 24% interest. Ouch. You are on the wrong side of the spread. But by moving that balance to a 0% introductory offer, you usually just pay a one-time fee, maybe 3 to 5%, and boom, you get up to 21 months of zero interest. Now, let's be clear. This isn't some shady get-rich-quick scheme. It's simply turning a massive negative spread into a positive one to protect your startup's lifeblood. Did you know the average small business carrying high-interest credit card debt loses thousands of dollars every single year just to interest payments? It's crazy. With this trick, you're essentially renting a chunk of money for a flat 3% fee for nearly 2 whole years. You aren't desperately trying to earn some huge risky return in the market. You are automatically erasing a 24% penalty. That is a guaranteed positive return that almost no stock market investment can reliably match, and it frees up your cash so you can actually run your business. And finally, section 5, auditing your credit score. I want to assign you some practical homework to make sure your future business rent is as cheap as humanly possible. Because honestly, everything we've talked about so far totally relies on your ability to access money on good terms. The rich don't have access to secret underground banks. They simply have access to cheaper money because they made themselves extremely cheap to lend to. Remember our very first equation? The spread is what the money earns minus what it costs. Most beginners obsess over the earning side, but the wealthiest entrepreneurs, they obsess over the cost side. Your credit score is the single biggest lever you have to drive down the cost of your rented money. So here is your step-by-step checklist. I want you to treat these like actionable commands. Step 1, pull your credit score this week. It costs you absolutely nothing and it sets your baseline. Step 2, audit the cost of your current debt. You need to figure out exactly what your money is costing you today. And step 3, immediately take action to knock points off your cost of borrowing. Get on the phone and negotiate with your current lenders, or go execute that 0% balance transfer we just talked about. As you can see, improving your score puts you in total control of lowering your rent. The national average score is right around 715. Moving from a fair score up to an excellent one can literally drop your interest rate by several percentage points on every single loan you ever take, whether that's a business line of credit or a mortgage. And every single point you knock off that cost goes straight back into your business spread, compounding into thousands of dollars in real savings. I'll leave you with this. Now that you actually know the math behind renting money, and you understand exactly how to use trade credit to scale with zero of your own dollars, what is really stopping you from building that business today? Debt isn't the monster under the bed, it's just a tool. Get the spread right, and it stops being the thing that owns you and becomes the thing you own. Get out there and start building.